Wendy's just delivered a double beat for the second quarter of 2026. I mean, adjusted earnings per share came in at 18 cents, which beat the consensus of 16 cents.
Right, and revenue hit $570.57 million.
Yeah, a 1.8% year-over-year increase, beating expectations of 557.14 million. But then, immediately after reporting those top and bottom line beats, management completely withdrew their full year 2026 financial outlook.
Just completely pulled it.
Pulled it entirely. And they slashed their dividend by 50%, bringing it down to just 7 cents per quarter.
Which is a massive cut for income investors.
Oh, absolutely. And yet, despite pulling all that forward guidance and cutting the yield in half, the stock popped 4.06% to close at $7.69.
Yeah.
That is a massive reversal from a brutal 7.5% pre-earnings sell-off just the day before.
It's wild price action.
Okay, let's unpack this because they beat earnings on paper but completely pull their guidance and slash their dividend in half. Why on earth did the stock jump 4%?
Well, the headline beat, driving that initial algorithmic reaction, is an absolute illusion.
Really?
Yeah, if you look under the hood of this Q2 report, you are looking at an exceptionally low-quality earnings beat. It was heavily padded by accounting adjustments.
Like what kind of adjustments?
Specifically, higher advertising funds revenue, and also inorganic company-operated sales stemming from when they acquired those 35 franchise restaurants back in 2025.
Ah, right. So it's not organic growth.
Exactly. The market didn't ultimately sustain that 4% bid because they loved the 1.8% revenue growth. The market is reacting to the fact that those surface-level numbers perfectly set up the brutal reality of their core operations.
And the desperate measures they're taking, I assume?
Oh, extreme desperate measures to salvage the company's capital structure.
So today we're doing a deep dive into the Q2 earnings call transcripts, the latest analyst notes from firms like JP Morgan, and recent Tryon Fund filings to figure out what is actually happening here.
Yeah, there's a lot to sort through.
Our mission for this deep dive is to separate the underlying operational reality of Wendy's from the trading mechanics driving the stock right now. Stripping away the accounting adjustments in those acquired franchises, what does the actual retail demand look like?
It's bad. The underlying retail demand is undergoing a severe structural contraction.
Like how severe?
Well, if we move away from the consolidated top line and look at global system-wide sales, that metric actually contracted by 6.5% on a constant currency basis.
Wow.
And in the United States, their core market and the engine of their cash flow, same restaurant sales fell 7.0%.
That's a huge drop.
But the most alarming metric buried in this report, the one that truly defines the operational crisis this quarter, is that U.S. customer traffic plummeted by 12.5%.
Wait, 12.5%. That drop in foot traffic is catastrophic in the quick service restaurant space.
It really is.
You are essentially looking at 1 out of every 8 customers just vanishing from the drive-through line year over year.
Poof, gone.
And the physical footprint of the company is already shrinking alongside that, right? Like evaporating demand.
Yeah, they saw a net decrease in unit count. 81 U.S. stores closed this quarter alone.
81 stores in 3 months.
Yeah. They did manage to offset that slightly, with 10 international additions, bringing their total end-of-quarter count to 7,180. But you cannot ignore a domestic contraction of 81 units in a single quarter for a legacy brand.
No, absolutely not.
Those 81 closures are the direct consequence of that 12.5% traffic drop flowing down to the franchise level. It shows that management has been trying to bail out a sinking ship by relying purely on pricing power.
Right. It's like they're trying to bail out a sinking ship with a thimble. They're raising prices on the few customers left just to offset the 12.5% that walked out the door.
That's exactly what they've been doing, artificially propping up the revenue numbers by aggressively raising average ticket prices.
But this Q2 report proves that strategy has hit a hard wall of consumer resistance. Which brings me to this point. Burger King officially overtook Wendy's as the #2 U.S. burger chain by system-wide sales recently. Is that just proof that Wendy's has completely priced itself out of the retail market?
Yes. You cannot simply price your way out of a 12.5% traffic deficit. And the margin profile reflects that failure immediately.
Give me the numbers.
Company-operated margins compressed by 200 basis points, dropping down to 13.6%. Adjusted EBITDA fell $22.5 million, down to $124.1 million.
Ouch. That 200 basis point margin compression is a massive squeeze.
Huge squeeze.
And it's not just a revenue problem, right? They're getting hit heavily on the cost of goods sold. Management specifically called out 5 to 6% commodity inflation.
Yeah, mostly driven by record-high beef prices.
Right, running parallel to ongoing labor rate hikes. But I imagine the primary driver of this margin collapse is severe traffic deleverage.
Oh, the traffic deleverage is the silent killer here.
Break that down for people who might not follow QSR mechanics that closely.
Sure. In the quick-service restaurant model, your fixed costs, so your real estate footprint, utility overhead, baseline shift staffing, they remain static.
Whether 50 cars come through the drive-thru or 500.
Exactly. So when your customer volume drops by 12.5%, the profit margin on every single remaining burger has to absorb a significantly larger share of that fixed overhead.
That makes sense.
When you combine that operating deleverage with 5 to 6% inflation on your core commodity, like beef, the margin gets crushed from both ends simultaneously.
So they have completely lost the ability to pass those surging input costs on to a consumer base that has already rejected their current price points.
Bingo. They lost the value war entirely to Burger King and McDonald's. Wendy's has historically positioned itself as the premium fast food option, justifying slightly higher price points with the fresh never frozen marketing.
Right, higher tier menu items.
But that positioning is failing now, and the new C-suite leadership certainly agrees with that assessment.
Yeah, because the operational bleeding has become so severe that the new management team had to address the erosion of the brand head-on during the earnings call.
It was unusually direct.
New CEO Bob Wright, who recently returned to Wendy's after a stint leading Potbelly, and the new CFO Steve Cirulis, they were bluntly honest with analysts.
Yeah, they admitted without hesitation that Wendy's quality differentiation, its core value proposition, and its marketing effectiveness have all significantly eroded over the last few quarters.
You rarely hear that level of candor from a management team on a public earnings call.
Almost never.
Usually C-suites hide behind heavily sanitized corporate speak about, navigating a challenging macroeconomic environment or temporary consumer headwinds. To flat out admit your food quality differentiation and value proposition have deteriorated is a really calculated move.
It is entirely calculated. By laying bare exactly how distressed the core business is, management is setting the stage to justify the extreme capital preservation measures they are taking.
Which explains exactly why they pulled their full-year 2026 guidance and shocked income investors with that dividend cut.
Right. They are aggressively clearing the decks to launch a massive 5-pillar turnaround strategy dubbed Project Fresh.
Okay, let's look at the mechanics of Project Fresh, because turnarounds in the restaurant sector are notoriously capital-intensive.
Extremely.
The first major pillar is aggressive menu optimization. They are launching a new Big E platform with specific $4, $6, and $8 value tiers.
Yeah, this is clearly a direct attempt to offer consumers a highly visible value proposition to win back that lost 12.5% foot traffic.
Without resorting to the kind of ad hoc, margin-destroying discounting we've seen from competitors.
Right. But at the same time, they're trying to upgrade their premium hamburgers and revamp their spicy chicken sandwich.
To defend their historical market share as a premium fast food option.
Exactly. They are attempting a barbell strategy here.
Meaning what, exactly?
Meaning, they're locking in the budget-conscious consumer with the tiered biggie deals to drive pure volume and fixed cost absorption, but simultaneously trying to win back the premium buyer with upgraded core items to defend their average check size.
That sounds incredibly difficult to pull off. The execution risk here is immense.
Oh, massive execution risk. Pushing a $4 value meal into the teeth of 6% beef inflation is highly diluted for margins in the short term.
So they are essentially using the biggie bag as a loss leader.
Yeah, betting that the increased foot traffic will eventually stabilize the margin deleverage we talked about earlier.
Wow. Beyond the menu, the second pillar of Project Fresh focuses on operational optimization, which involves reallocating labor and marketing spend across different day parts.
Right, they are actively reducing their exposure to the highly competitive, less profitable breakfast window.
Which everyone has been fighting over for years.
Yeah, it's too crowded. Instead, they are pushing those resources toward the late-night day part, where there is arguably less premium competition and higher margin potential.
They are also leaning heavily into their digital capabilities, which was honestly one of the few actual bright spots in this Q2 report.
Yeah, the digital numbers were good.
Digital sales now account for 23.7% of global system-wide sales, up from 20.5% a year ago.
The digital growth is critical because it drives higher ticket averages and better customer retention data.
Right. The app loyalty.
Exactly. They are also looking aggressively beyond the U.S. for growth to offset the domestic saturation. International system-wide sales actually grew by 3.4% on a constant currency basis.
And didn't they just sign a massive franchise agreement in Asia?
Yes, to develop up to 1,000 new restaurants across China over the next decade.
So that international expansion pipeline is meant to serve as a long-term growth engine.
Correct. But in the immediate term, all of these pillars, the menu tiers, the daypart shifts, the digital apps, circle back to one critical objective.
Stabilizing franchise economics.
Yeah.
Because franchisees operate the vast majority of Wendy's locations. The corporate entity is heavily reliant on a royalty revenue model.
Right. And if franchisees start defaulting on leases or shutting down operations due to this traffic collapse,
Which we're already seeing with those 81 closures.
then corporate top-line revenue implodes. That explains the extreme capital allocation decisions we saw in this report.
Right. Cutting the quarterly dividend by 50% from 14 cents down to 7 cents, which drops their annualized yield to about 3.6%, is a textbook distress maneuver.
Completely textbook.
Furthermore, they halted all 2026 share buybacks, leaving roughly $35 million untouched on their existing authorization.
They have zero margin for error when it comes to capital allocation right now. They have to retain every single dollar of cash flow because their balance sheet is deeply stressed.
How stressed are we talking?
Their net leverage ratio is sitting precariously high at 5.0 times adjusted EBITDA.
Wow.
Yeah, that is perched at the absolute high end of their target leverage range. When you have declining traffic, compressing margins, and a 5.0x leverage ratio, you do not have the luxury of paying out a generous dividend to appease retail shareholders.
No, you have to hoard cash just to service your debt, keep the lights on, and fund the rollout of Project Fresh.
Exactly.
But here's where it gets really interesting. You cut the dividend to fund a turnaround, but your leverage is maxed out at 5.0x in a tightening consumer economy. Is Project Fresh actually a viable rescue strategy, or is it just corporate speak for we are completely out of options?
A huge gamble.
Right. If the $4, $6, and $8 biggie tiers fail to reverse that 12.5% traffic decline, the 5.0x leverage becomes an existential threat to the equity.
Absolutely.
And that desperation brings us to the real reason the stock popped 4% on terrible fundamentals. The underlying business is struggling, which naturally invites private equity opportunism.
Oh, the entire price action of the stock post-earnings was driven by Nelson Peltz.
Peltz is Treant Fund Management.
Yes. They currently hold a roughly 16% stake in Wendy's, and they are reportedly exploring a take-private bid for the company.
So the 4% stock jump, the massive trading volume, it had absolutely nothing to do with investors loving the earnings beat or buying into the long-term vision of Project Fresh.
Nothing at all. It was entirely an event-driven arbitrage trade based on buyout rumors colliding with extreme market positioning.
The market mechanics behind that price action are wild.
Yeah, they are.
Because leading into this earnings report, the bearish consensus on Wall Street was overwhelming. Short interest stood at over 46.29 million shares.
Which is massive.
To put that in perspective, that represents nearly 30% of the entire public float. You had a massive portion of the market actively betting that the stock price was going to fall further, anticipating the dividend cut and the pulled guidance.
And that explains the 7.5% drop the day before earnings.
Exactly.
That massive short positioning was amplified by severe institutional capitulation just before the report. Major firms like Vanguard Group were reported to be selling off large blocks of shares.
Everyone was running for the exits.
Yeah. Analysts at firms like JPMorgan Chase had reiterated an underweight rating with a $6 price target. The institutional market was essentially throwing in the towel, assuming the leverage and the traffic drops were unfixable in the public markets.
But then the Peltz buyout rumor hits the wire. When you have 30% of the float sold short and suddenly a battle-hardened private equity titan like Treant signals, they might buy the company at a premium.
It creates absolute panic among short sellers.
Right.
The 4% post-earnings stock jump was heavily driven by shorts scrambling to buy back shares to cover their positions before a definitive buyout price could be announced.
It effectively created a mechanical short squeeze.
Exactly, a squeeze that absorbed all of the institutional selling pressure. And for a private equity firm like Treant, a take-private deal makes a lot of strategic sense here.
Because they can do the dirty work out of the public eye.
Right. They can take this distressed asset, Remove it from the glare of quarterly public earnings reports, aggressively trim operational fat, optimize the real estate portfolio, and unlock cash flow without worrying about a stock price plunging every 3 months while they execute a turnaround.
But this feels like a game of high-stakes musical chairs for retail traders listening to this.
Oh, it is. The risk profile is highly asymmetric.
You're buying in strictly for the Pelt's buyout premium, hoping to ride the short squeeze. But if Trian looks at the 12.5% traffic drop, looks at the 5.0x leverage, and decides to walk away, the floor falls out.
Yeah, you are left holding a highly leveraged, shrinking burger chain that just lost its market position to Burger King, hoping that a $4 value meal can organically save the balance sheet.
It's a terrifying position to be in as an investor.
It really is. The headline numbers look clean on the surface, a nice tidy 18 cents per share, a beat on revenue.
Yeah.
But you strip away the accounting tricks, and you see the underlying machinery is totally jammed.
Completely jammed.
And honestly, this raises a critical macroeconomic question that goes far beyond just one company's earnings report.
What's that?
Well, if a legacy heavyweight like Wendy's, a brand that essentially invented the premium fast food tier, requires a billionaire buyout just to survive a 12.5% drop in foot traffic, what does this signal for the rest of the highly leveraged mid-tier restaurant sector heading into a tightening consumer economy this fall?
That is the big question. Make sure you follow the show for a daily, no-nonsense earnings coverage.